All right, that should do it. Good morning, everybody. Hope y'all are ready for this. Seems like the administration is calling a pause on aggression while they run diplomatic talks over the next 5 days. That headline came in not too long ago, well, like 15 minutes ago, something like that. And you can see it turned everything around all around the world. So whatever we were doing is off the table, right? Normally we come in and we look at what was going on in the overnight, how it proceeded around the world, and it kind of gets us set up for today's trading. We have no need of that since everything has kicked off, hopefully while you were still awake. I mean, it wasn't that long ago. So now we have to be concerned of the potential to retrace it. It is a liquidity gap in fashion, but this is a different one than normal. So don't expect that it's going to behave the way a typical liquidity gap would behave. And even if we was going to retrace it, it very likely wouldn't happen in the same day. I would recommend marking that starting point and keeping it on the radar. You might need it later. Otherwise, we're looking good around the world. US markets, Japan, Europe, Asia, everything just is doing really good. The UK is not necessarily keeping the push as much as others, but on Friday we were talking and I was kind of thinking we might get something like a turnaround Tuesday, a little bit of a push. Oh, they didn't wait. No. Didn't wait even a little bit. Nothing in this list of stuff is going to take away from what's happening this morning. I don't like to discount any Fed speakers. They can inadvertently say something that they didn't mean to say. They can be taken out of context. Um, Whoever's covering it can just straight up lie or misrepresent something that they said. So there's always the possibility that things go wrong when you have any Fed speaker out there chipping their teeth. So while I'm not expecting anything out of Goolsby and Mirren, just be cautious when you see a Fed speaker talking. The thing is, now we know this says TV appearance, so it's probably live, but on different sites it might just say they're speaking, and you want to dig into where are they speaking at and is it actually live? Because sometimes they'll record it and they'll send it in, or maybe they'll be meeting at Girl Scouts or Boy Scouts of America, and they're going to just do a little fluff PR thing and they're not going to talk policy, they're not going to make statements, or there might not be any reporters, they might not be taking questions. So just because you see that there's going to be a Fed speaker today, don't automatically assume that you have to keep tracks of it while it's happening and monitor it. You can dig deeper and find out what, who, when, why, right? The typical investigative things that we always have to do. And if you find out that it's pre-recorded or that there's not going to be any Q&A or any conversations with reporters, then the threat bias drops significantly. We got some auctions in the front end, but these aren't the ones we're looking for, so they shouldn't be a problem. It's the 1 o'clock auctions that you really want to watch out for. The 10, 20, and 30-year bonds. These, you could just track the IRX, and that'll keep track of the front end. These shouldn't be an issue. Brent dropped more than 9% in that headline. Very nice. We'll take it. It is good to see that precious metals are responding. They kind of got beaten up a little bit. It's probably too early to see anything in this, but it doesn't hurt to just come in and take a peek. Yeah. So over the last week and a half or so, they've been pricing in rate hikes. So we're very likely going to see that get unwound. And unwinding rate hikes is going to give us a more lift in the S&P and the Nasdaq. So there's no rush. They can take their time, and it wasn't a massive amount anyways, but it's just more fuel to the upside, right? So we'll take it. Way too soon to see this move. CTA positioning is going to be slower to track. The data that provides the movement to this line is not a continuous all day data, right? It's not like looking at equities or at the indexes where we have a second by second update. So the data that makes this line probably won't update until the overnight tonight, and then we could possibly see something tomorrow. And then there's a bigger update that comes out on, I believe it's Fridays, but we won't see that. So if you think about Friday that just happened, we'd see that today, tomorrow. But for this news, it would have to go to Friday, and we wouldn't see it until Monday or Tuesday of next week. So probably won't see much in the CTA positioning yet. We got to let that play out a little bit. All right, we got moderate risk coming out of the White House. Looks like there's a meeting today at 1 o'clock. It's about a Memphis Safe Task Force roundtable, but any meeting like that can be hijacked by the president answering questions or just deciding he's going to use that forum and that time and that space to make statements. So watch out for 1 o'clock today. $337,000 in the overnight volume. The average is around 50 something, 55 ish. When the headline came out, we were sitting at around 200 and something. So in the last 25 minutes or so, we gained another extra 100,000. We're getting a lot of volume, is the point, right? Now we had the contract change, and I get it. It always messes with new futures traders. If you've never seen it happen before, then it's frustrating and it's confusing, but it's done now. If you go to your continuous contract, you don't have to choose your individual contract. So, ESM26, you don't have to do that. You can just look at your continuous again. Everything is back to normal. Your lines should work the way that they're supposed to, and everything should just function well again. If it isn't, I'd be interested in what broker you're using, because I do kind of keep track of that myself. Some brokers won't let you use a continuous, or they won't let you trade with the continuous. You can use it, you just can't trade on it. Like Tradeovate has a continuous, but you can't use that one to trade. You still have to pick your contract. So, for those traders, I get it. You probably aren't looking at the continuous anyways. One thing I always like to remind people that they lose track of, especially newer traders, unusual price action is not high probability, high conviction stuff, right? Technical analysis was designed and it is derived from looking at previous price action, looking at what price normally does, spotting reoccurring patterns in behavior, and then using that to take trades when we see it unfolding again in the future. So as long as price is behaving in a normal way, your ability to read it, anticipate it, and make money from it really goes up. That's the sweet spot. Doesn't get any better. When you have unusual situations and unusual price action, that's where things start to get rocky. Technical analysis doesn't work so good in that environment because it wasn't meant for that environment, right? So I'm not saying you can't trade it. It's just that you're in a high risk zone when you are trading in price action that is not behaving normally. And a 250 point move in 5 minutes, that's not normal. It's not the worst we've ever seen. We've made bigger moves than that, but they don't happen very often. So proceed with caution. You know who you are, but there was someone who was long this morning. They just happened to have already been in it, and it took them ripping to the upside. Congratulations on that. You got to take the win when you can get it, right? Because I promise one of these days you're going to be in it and it does the opposite. And, well, it just sucks. So at least this one went in your way. It feels really good to get one of those kind of wins. It wasn't me. I had already been done, but yeah, congrats. Take what you can get, right? That's a heck of a run. All right, so we still got the moving averages fanned out. We want to be keeping our eye on this. We've got the outside bar this morning. You can see the blue bar completely in shadow to Friday's bar. We were underneath it. Now we were over its head. We've rejected on the 200-day moving average and came back in. We are back inside of Friday's range. It makes sense that we have to shake some of this around, right? I don't necessarily think that we're going to retrace the whole thing like a typical liquidity gap, but so far, if I brought up all of my liquidity gap examples that I use for teaching it, that's a textbook pattern and it's a textbook setup. I don't know. It's too early. We're going to need to play it out a little bit. A couple of things that I would recommend is digest this bar, right? So get all that stuff out of the way for a moment. This is your event bar, and that one single bar all by itself can provide you with analysis, right? So we just get rid of this stuff. This is the halfback, 6620. It's the halfback for that one single bar, and that bar is bossed now. We have to resolve this bar before we can do anything else. The typical textbook example is that there's nearly no wick in the opposing direction. We close in the upper 25% and we spend the next 2 hours working back down to where the gap started, 6511 cog line. When this first happened, I did not immediately think, oh yeah, sweet, we're going to get a gap close, because this isn't our typical gap close situation, but it is a textbook setup. So if we break the half, we're going to target the whole. The probability of us breaking the half is not as high as I would like. Right now, that is the target. We set a high, and then we've set a lower high. We set a low, and now we've got a lower low. So we're working in that direction. We want to continue to work with what we've got, not with what we want or what we assume. And so play the half. Once we are through the half, then we'll work on getting the gap closed. If we get below the half and then come back above it, then we'll target the high and work to the upside. But right now, we're just going to run it till it breaks. The old phrase that we use is if we get to one side early enough in the day, we can go to the other side by the end of the day. That does not take account of situations like this. So we don't really want to apply that today. To even get that, we would need to work our way back down through these levels. So first we have to get to the yellow line here. That's the full ADR. Get underneath it and then get to the mid, breach that, and work our way back down to where this candle opened. That's a lot of work all by itself. Along the way, we've got yesterday's RTH high, yesterday's close, and yesterday's low. Globex open, Globex low. So we got a lot of stuff that we need to work on, right? If we was to make this trip back down, all of that needs to be resolved. A 125 point average daily range. We exceeded that, obviously, plus some, and we kept going. We ran all the way to the 200-day moving average before we were rejected. All right, we had an MDP before the news. That's a missed daily pivot. We don't have that anymore. We cut through both. At the moment, we're negotiating with the weekly pivot from above. So we'll see if that holds or not. Today's floor pivot is lower than yesterday's. That's bearish. Price opened underneath it. That's also bearish. Both of those kind of get canceled out simply because we're above all of it on that headline. So unless we wash that headline out, these are done. It is worth considering where the R line was, since we did reject off of things to the upside. It's easy to assume that it was the 200-day because we hit it and stopped there, but it's worth looking to see if there was anything else up there. We had R2, but we didn't get to it. We are back underneath the R1 level, so now we want to focus on staying underneath R1, getting back through the floor pivot, and negotiating with the S1 down here, which is really close to that 5-minute open. I mean, it's not to the tick perfect, but it's dang close. I would say at this point we're done with this August point of control zone that we had marked out, so we'll take that off. And as you would imagine, we've got a classic lowercase b profile, right? Really thin, large distribution, point of control. We didn't make it up to 67.71, but if we find stability on this price shelf here, then we're going to likely make another run at it. Get through our own high that we've already set, 67.50, and then we'll challenge this point of control, 67.75-ish, rounding up. It is a zone up there, right? It's a pretty wide zone, all things considered, all of this. But that big round options level, 67.50, needs to be negotiated before we can get to that point of control at 75, right? $10-day, 30-minute volume profile in TPO. We are negotiating with the value area. Looks like we made it to the point of control, but we didn't make it through. So if we do make another attempt to run back up, that 67.50 level is where the 10-day point of control is at. Now, throughout Wednesday and Thursday of this week, we're going to be working on these candles back here. Unless we get above 68.90, then this profile should get a little bit shorter, right? This would be our new home at that point, which it's still a really wide profile. It's 400 points-ish, 380. It's a lot. If we do run back up there and say we get above 6,900, then it won't matter whether we take those candles off or not. We do have a relatively decent distribution, all things considered. I know it might not look that great, but it's cleaner than you would think with a classic distribution. The TPO is actually the uglier one this time, and that's saying something. It's not normally. If we get through that point of control, that 6,800 area, and the value area high of this zone around 38 or 40, this zone is going to be the next area of trouble if we can get through that 67.50. I had mentioned over 100,000 in volume came in after that news hit, and we can see where it's all building out, right? No VPOC from last week. We're done with that. We did have a VPOC from last Wednesday. We hit it this morning. I'm going to put it back on there in case we make a run back to this high, right? Otherwise, we're done with this point of control. It's not a VPOC anymore because we've already hit it. So don't want to label it as a VPOC. It's just a POC. Give it some odd color we don't normally use for that. Make it stand out. So we want to get rid of it. Don't want to keep it. $67.32 cog line. Wednesday's POC. I didn't get it to the tick perfect. That's kind of not the point for me. Close is close enough. So if we do make a run back up, we're going to have to negotiate with that level. Once today is done, I'm going to remove this level. It won't have any value for me anymore. But for today, add that to the list of levels to keep track of overhead. All right, on Friday, we get a preview of the upcoming week's range. Kind of gives us a feel for what the markets are thinking. That's the SPX. It's not going to do us any good. There we go. All right, and sometimes this happens. So because of the contract change, it retroactively scrunched all that up. That's not going to help us out any. Friday afternoon, I compared what we had, and it was just about the same size. What I'm doing here is I'm just skipping last week, and I'm going to the week before. And you can see that the week we have now is very much like the week we had before the FOMC week. It's a little bit bigger, but not much. What we're looking for here is outsized bars. So if I had a range, that was really significant like that, that would really stand out, right? It's a really big range. We don't have that. Or if it was a much narrower range, right? Really, a really compressed range for the week, then that would stand out. But we don't have that. The fact that this week's range is very similar to previous week's range doesn't give us anything, and that's okay, because if you don't have nothing, then you can just go look at something else. But if there was something here, we would have it, it would stand out, it would be helpful. We just don't. So that's the way it goes. We do have the weekly edge and the idea that price should close within this weekly range. Even on that run to the upside, we wicked out of it and shut down there and came back in again. Yeah, it was the 200-day moving average, but it also was the weekly expected move edge. So we'll take it. We still need to let this play out. Pretty sure that the push got us through. Nope. All right, so here's the 10-week. On that run to the upside, we got really close to it, and now we've fallen away from it. I wanted to go check because, in the pre-market, some of these tools on Thinkorswim do okay, and then some not so much. So it was worth checking. We're still underneath the 10-week, less than 2%, but we are underneath it. We're working our way back. The day isn't done, so we could have had these low days from last week, and then by the end of today, we could be back to zero or close to it. What we want to watch for is the previous lows that we did see last week. It was around 3%. If we get further than that, we have the opportunity to drop a lot farther faster. You can see that when it cuts loose, it can get really nasty quick. 3.5 is usually the cutoff point, the place where we tend to pause, reconsolidate, begin working our way back the other way. So if we exceed that and get to, say, -4, it's probably going to get ugly fast. So that's the weekly. Looking at the 10-day, we're 1% below the 10-day. That's not much. We don't have a lot to be concerned with here at this point. 1% is really no big deal. But if we get below, say, 2 or 2.5%, then we're going to have a bit of a problem. So keep your eye on it. See if we can exceed that 2.5 or 3% move to the downside. If we get that far down today, it could get a lot uglier quickly. Seems like we've had a day like this before. There's not much in the day-to-day trading world that is new, right? These days they repeat over and over and over. And even this gotcha headline where we ripped 250 points to the upside, we've had that before. Even that's not new. And we've had some where we made that big move and we kept it and we kept on going. And then we've had some that unwound it. Obviously, we're giving it back, but how much are we going to give back? And how did it all play out by the end of the day? I've got to go back and check my notes. I keep track of these different kinds of days for a reason and try to figure out what happened when we did this before. I don't know. I'll let you guys know what I find, but we have had it before. Shouldn't be that hard because it's going to be attached to a significant change in news. One of those kind of situations. Looking at what is still down this morning, Bitcoin, gold miners, the Mag 7 down volume, China, and really that's about all we've got to the downside. Looking at what's up this morning, what's almost everything else. All right, bonds are a little weak. Communications not quite there. China is split. We've seen that the China index was down, but the China Internet ETF KWEB is up. Metals and mining, uranium, banks, the mags, growth, uranium, building materials, healthcare. Yeah, everything is up here this morning. Expanded tech or software, we got it all. So from a market breadth perspective, we have the market breadth to sustain a push to the upside. The problem is market breadth may not be in control, right? Just because we have those kind of juice doesn't mean that they're the ones steering the bus. So we want to continue to keep our eye on crude, VIX, the dollar, bonds. Let's see what's going on out there and which one finally takes control and who becomes dominant. We know there's going to be a power dynamic for a little bit between the dealers, right? That dealer positioning is going to have to get uh, reorganized, to say the least. Shuffled. Don't know what word we want to use there. All right, looking at the Nasdaq, names that are down at least 0.5%, none. So we have no names in the Nasdaq 100 that are down at least 0.5%. To the upside, we've got 90 names in the Nasdaq 100 are up at least 0.5%. Now that's bullish. If you want to have an example of what bullish market breadth looks like in the pre-market, that's a really good example right there. 90 names out of 100, that means 90% of the Nasdaq is up at least 0.5%. At that point, you don't even have to try to sort by sector or industry or anything like that. Looking at the S&P 100, 75 names are up. So at 75% of the S&P 100 is up at least a half of a percent. Transportation, technology, retail trade, manufacturing, healthcare, finance, tech, consumer services, all the good stuff, right? And we can see semiconductors in there, big banks. So we've got the breadth. We do have that. The biggest argument is going to be who's driving the bus. So we're going to need to get through the open, shake out all those market on open orders, the MOO orders. Got to get on the other side of that, see how much the dealer positioning changes the landscape, and then keep your eye on the VIX and crude as a tail. But the last I saw with those, it was just, WWE SmackDown. A little bit of a rebound on USO. And for the VIX, we didn't quite get down to that 2250, but we got close. Looks like the VIX retraced half of that move, close to what the ES did. NASDAQ seems to be holding up a bit better than the ES at the moment. Although they are both above their ADR full. All right, so heed that warning. Let everything shake out at the open. Give it a good 30 minutes. I know there's a lot of people who like to trade the open. I'm not one of them. So if that's your playground, cheers to you. You can just ignore whatever I'm saying and go do you. But if you don't have a an approach, that's not where you want to play. Everybody, be careful. Have a good day. I'll see you.